You're fine? Do you see me and hear me correctly? Thank you. Okay, great. So it seems that everything is working well, so we can start the lecture today. So by the way, before forgetting to give you some information, so tomorrow we will have another lecture. Nothing on Thursday, and then question and answer session on the 26th of May. So in other words, tomorrow it's not going to be the last lecture. Okay, tomorrow last lecture for the course, but one more lecture on the 26th of May for questions and answers. Right? Is that clear? So you can write down on your schedule the Q&A session on the 26th of May. Is that clear? Okay, I think it's common to all the courses. Okay, so we are going to first finish the exercise we started yesterday. That one. Time to so it should be working. Wait a few seconds. I don't know. Why is this? Yes. So now it's working. Okay. So let's start. So I'm pretty sure that you remember this exercise. This exercise is based on the saving and loan crisis in the 80s in the US, and the goal of this exercise is to show you why this crisis happened actually during that period of time. No. Okay. So yesterday we already saw that there was a problem of two problems actually. Two problems. First, so the deposit insurance implies no monitoring by depositors. First point. And second point, limited liability. So it makes bankers to benefit from upside risk but not to bear downside risk. Therefore, there is incentives to take excessive risk taking behavior, excessive risk taking behavior. Okay. So we talked already about that, but just to be sure, look at question 3. So given your answers to questions 1 and 2, do you think that the existence of deposit insurance combined with lax regulation caused a moral hazard problem that ultimately provoked the crisis of the 80s? Well, the answer, of course, is yes. And it is what is developed in this paragraph. So let me write it. Let me read it, read it. The design of the insurance mechanism, so the security deposit, combined with lax regulation, has created a costly moral hazard problem in the S&L management. Security deposit encouraged S&L to engage in risky behavior, as their liability was limited in the event of underperformance. So limited, liability limited in the event of underperformance. So this is protected against downside risk. While the profit in case of successful investment were high. So this is actually benefiting from upside risk. Okay. So in addition, insurance encouraged depositors to stop worrying about the investment made by the institution to which they had entrusted their money. So no longer any monitoring by depositors. Okay. Such a combination of factors encouraged risk-taking and fraud. Insurance was a viable economic guarantee as long as other regulatory mechanisms prevented S&L managers from pursuing a reckless policy of risky investments. In the early 80s, institutions controlling S&L investments adopted lax policies. At the same time, the depositors' insurance system provided them with a better guarantee, while funds for the regulatory systems were reduced. Inevitably, the whole system collapsed. Okay, so this is history. So now we're gonna look at an example, but actually this is the correction. So let me just look if I don't have another version without directly the correction. Not that one, sorry. No, not that one. Okay, so, okay, anyway. You hear me or you don't? Okay, I'm sorry about the internet, but you know, I don't know how to modify it. So let me come back to this. Okay. So here is the very easy example. So in order to simplify the presentation, we consider that the interest paid to depositors is just equal to 0. And this is without loss of generality. Suppose that S&L owners have complete freedom in the investment choices to make with deposits. And for simplicity, they have the choice between a safe or risky investment. Characteristics of the two types of investment are described in the following table. So in this column, you have the characteristics of the safe investment. And here you have the characteristics of the risky investment. Same initial investment, 200. But then you see that the return can be either a success or not a success. Okay, so if it is a safe investment, in case of success, the return is 210. And if it is not a success, the return is just 200. And the probability actually is the same, 50%. Okay. So you see that if you compute the variance, it is strictly positive. So we have a random variable, okay? But here we're talking about a safe investment. How can we interpret the fact that we are talking about a safe investment? Well, just because in all the cases, the return is higher than the cost. So there is no risk of default associated with the safe investment. No risk of default. Why? Because the mean of 2010-2000 is higher than 2000. And remember, no interest. No interest paid to depositors. Okay. So what about the risk investment? Well, in that case, in case of success, the return is 2030. But if it is not a success, the return is just 160, which is strictly lower than 200. So in that case, there is default. And possible to repay debt. So this is why it is possible to say that this investment is risky actually. Okay. So you can also, what is easy to compute is the net present value. Because here, without discounting, without taking into account discounting. Because here, the cost of borrowing €1, whatever you want, is just 1. So NPV, if this is the safe project, it is 0.5 times 210 plus 0.5 times 200 minus 200. It is 5, which is strictly positive. So there is wealth creation. What is the NPV of the risky project? 0.5 times 230 plus 0.5 times 160 minus 200. And this is minus 5, which is strictly negative. So in that case, there is wealth destruction, not creation, but destruction. Okay, so this project should not be, I mean, the risky project destroys wealth. So it's not a project to undertake. Okay, so this is basic basic stuff from basic corporate finance, right? Okay. But now we are going to look at what a banker protected by the limited liability is going to do. Okay, so the funds available to an SNL to invest or lend money come mainly from two sources: deposits and owner's capital. It is assumed that the owners are required to make a deposit equal to 5% of the total funds invested. In our case, this corresponds to an amount equal to 10. The remainder of the investment, 190, therefore comes from deposit. Okay, so just give me 1 second, please. So look at the following table or chart. So this is for the safe investment. Okay. And so there are depositors, owners. So the insurance deposit corporation, and the total, that is what the total of each line. So starting with the initial investment, we know that the total is 200, which is divided into 5% of capital coming from owners, and the remaining part, 190, provided by depositors through deposits. So what is how is divided the return between depositors and owners, whether it is a success or a failure? So if it is a success, it is 210. So there is 190 to depositors and the difference 20 to owners. So this is basically this line, and nothing is paid by the FSL IC. Okay. So in case of failure, well, not very complicated. In case of failure, the return is 200, which is divided into 190 and 10 to owners. So 190 to depositors and 10 to owners. Okay. Okay, so knowing that, we can compute expected gains. Well, expected gains, for instance, for depositors, very easy. So expected gains for depositors, it is 0.5 times 190 plus 0.5 times 190. So always the same, 190. What about for owners? Well, it is 0.5 times 20 plus 0.5 times 10. So it is 15. And finally, if you look at net expected gains for depositors, well, it is 190 minus 190, 0. But they are always repaid, and for depositors, it is 15 minus 5, 10. 15 minus not 5, sorry, but 10. 5. Okay. So this is basically what is written over there in the net expected gains, and you see that the entire net expected gain from the project, so the entire net expected gains of the project go to the owners. Depositors are just always repaid, but there is no risk. So no risk for depositors. So no risk for depositors. So no risk for depositors. And so the FSL IC doesn't repay anything in that case. Okay. What about the other case? The other case is with a risky investment. So here is the answer, but we are going to talk about this answer later. So is that clear so far? I mean, do you hear me correctly? No problem with internet? Clearly, okay. Okay, great. Okay, good point. Okay, thank you very much. So what about the risky investment? Well, the initial investment is the same, 200. But in case of success, the return is 230. So in that case, of course, you're going to have 190 paid to depositors, and the difference between the two, 40. 40 are paid to the owners. So what about in case of failure? So here you have one possibility, and I'm going to talk about another possibility later on. So the first possibility is that you see that 160 is not enough to repay neither, it's not enough to repay either the depositors or the owner. So in that case, the deposit insurance corporation is going to intervene. So in that case, we assume that the FSLIC both pays depositors, but also the owners of the firm. So you see that there is 40 which is missing in order to obtain 200. So this is why for the deposit insurance corporation, the price to pay is 40. So there is a loss of 40. So in that case, there is minus 40 in the column. So if you look at expected gains for depositor, always 190, because in case of failure, let's say, well, when it's not a success, the deposit insurance intervenes and repay depositors. And what about owners? Well, in that case, they obtain 0.5 times 40 plus 0.5 times 10, 25. Okay, so they enjoy benefit upside risk and do not support downside risk. So of course they have the up, but they don't pay for the down. So net expected gains are much higher by taking the risky investment than the safe investment. Okay. So of course, if you look at expected gains, it is 25. And the net expected gain, it is 25 minus 10, 15. Okay. And there is an expected loss for the deposit insurance corporation, which is 0.5 times 0 plus 0.5 times minus 40. So it leads to minus 20. Okay. So obviously, if you compare, it's very easy to see that by comparing expected gains, well, of course, the banker, or let's say the bank's manager, inevitably strictly prefer to take the inefficient, because NPV is negative, the inefficient, risky project. Okay. So you understand this? Yes, is that clear for everybody? Okay, so if it is clear, let me talk about another possibility in terms of answer. So maybe you can believe that, let's say in case of failure, the banker is not going to be repaid. And you could be right for this. So I'm going to redraw this. So what we're going to do now is to look at another possible answer. So the other possibility is to say, well, of course, in case of success, owners of the bank obtain the difference between the return of the project and what has to be repaid to depositors, 40. But in case of failure, let's say the deposit insurance corporation is only going to reimburse depositors. So for owners, it's 0. So in that case, the expected gains are no longer 25, but just 20. And the net expected gains would be not 15, but 10. But you see that 10 is still higher than 5. Okay, because even in this situation, owners are still protected against downside risk. Why? Because of course, in this situation, in case of failure, they are losing their money, but they don't have to repay depositors because they don't have to repay depositors in case of failure. Okay. Then don't pay $30 to reimburse depositors. This is the FSLIC which pays. So it pays depositors in case of failure. So still, the choice of the bank's manager would be the same. The bank's owners would still be the same. Okay, I mean, choosing the risky investment because once again, the limited liability makes them benefiting from the upside risk, but not bearing the downside risk. Okay. So the rest is very easy. So what investment choice would you make if you owned the SNL? Well, the choice would correspond to the one with the highest expectation of earnings. That is the risky investment. So remember, 15 strictly higher than 5, or even 10 is strictly higher than 5. Who should bear the losses when the results are unfavorable? In our case, due to the creation of the Federal Saving and Loans Insurance Corporation, well, this is the insurance institution who'd bear the losses in the case of adverse results. So in the case of the saving and loans, it would be the FSLIC. Which would support losses in case of adverse results. Okay. So this exercise is actually finished. So do you have questions about this exercise? Let me know. So I don't see anything, any question. So I'm gonna start with the with another exercise. Okay. 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 Okay, that one. So this exercise is to make you understand what happened during the huge subprime mortgage crisis. Okay, so this exercise examines the impact of the financial crisis on a very simplified banking system and its possible consequences on the country's credit supply and economic growth. The balance sheet of the commercial banks before the outbreak of the financial crisis is given below. So this is the balance sheet before before the financial crisis. Okay, so if you look at the so it is commercial bank. It is an example of a commercial bank before the financial crisis. Okay, so the bank has set up minimum reserves with a central bank of 200. So the reserve requirements amount to tap 2% of deposits. So here you have deposits. Okay, this is compulsory for banks. And there is a refinancing from the central bank for an amount of 1,100. So what is the idea of this refinancing from the central bank? Well, we talked already about interbanking market, and actually the central bank also provides debt, short-term debts to the banks in order for them to have a balanced balance sheet. Assets equals to liability. Okay. So for the calculation of solvency ratios, loans granted to household and businesses are weighted at 1. So in other words, if you look at here, the way we are going to compute the risk weighted asset is with the standard approach. So we're going to have weights. So going to use weights. Weights, right? So there, the beta is equal to 1. Okay. Moreover, for corporate bonds, it's the same. weighted at 1. Other private securities and the portfolio of RMBS, which is basically the main problem with the subprime crisis, because this is residential mortgage-backed securities. That is to say, mortgage-backed securities such as subprime mortgages. So here as well, same thing, beta equals to 1, just to simplify. On the other hand, OECD state securities are zero-weighted as they are deemed to be at risk, no risk of default. So beta equals 0, and of course it's the same for the account to the central bank. Okay, so what else? Well, over there is tier 1 capital and tier 2 capital. And if you make the sum of the two, you obtain the level of capital, which is 1,100, sorry. So the shareholders' equity consists of a share of the bank's equity taken into account in the calculation of the tier 1 ratio, and secondly, general provisions and subordinated debt, which corresponds to tier 2 ratio. The solvency ratios are determined by related the amount of tier 1 to the amount of weighted assets, so risk weighted assets, or the amount of tier 1 plus tier 2 to the amount of risk weighted assets, which corresponds to either the Cook or the McDonough ratios, so called the international solvency ratio. Okay, so just one remark about tier 2. So in tier 2, you've got subordinated debt. Okay, I see. I will. Okay, great. So in tier 2, there is included subordinated debt. So why is it? Because there we're talking about what is important, what is important. For debt is the priority of the debt. So the higher priority of debt, the more you are going to be repaid in case of default. So in other words, there is an order of priority to reimburse debt holders in case of default. And debt holders with the highest seniority, we are talking about seniority of debt. So debt holders with the highest priority are paid first in case of default, and so on and so forth. Okay, so the higher the seniority of the debt that you hold, the higher the priority in terms of reimbursement you've got. Okay, so when we talk about subordinated debt, when we talk about subordinated debt, we talk about debt which is not the one with the highest priority, seniority. Okay, so it is subordinated to another debt. So whenever we talk about a subordinated debt, it means that there is another debt with a larger seniority. Okay, when we talk about subordinated debt, it implies that there is another, most of the time we talk about tranche of debt already issued by the firm, in our case by the bank, is a higher seniority. So this means that people having subordinated debt, to some extent, they are not so protected. In some extent, they are a little bit like equity holders. Okay, because in case of default, probably they're going to lose money. So this is why before Basel III, so this is why before Basel III, actually subordinated debt was included in Tier 2 capital. Okay. So there was a question about refinancing by the central bank. Well, it's very easy. You know, if you pari passus means equal. Okay. So if you look at syndication, you know syndication. You know what syndication is? You know this meaning? You know what it means? Syndication. Okay, so let me give you an example. Someone, an entrepreneur, whoever, so someone is looking for financing, right? Yes, syndication loan, exactly. So the investment is quite important. However, let's say the investment is rather risky. So it's impossible to find a single investor ready to finance the entire project. Okay, exactly. Syndicated loan is when a project is financed by a group of investors. That's right, exactly. So, so in that case, you don't have a single investor, but a group of investors. But moreover, you have tranches of investment. So there are, well, for instance, a bank or a financial intermediary. So a financial intermediary creates tranches of debt. So, for instance, if you want to, I don't know, finance 1 million euro, so the financial intermediary is going to create 10 tranches, each for an amount of 100,000 euros. Okay, but it's not the only point. That tranches are going to be associated with different levels of seniority. There is, let's say, the first tranche is with the highest seniority. So this means that in case of failure, tranche 1 is going to be repaid first, and then the rest of debt. Okay, so by doing that, by considering different tranches with different seniority in terms of repayment, per se, you are creating senior debt and subordinated debt. So by doing that, the financial intermediary creates senior debt and subordinated debt. Subordinated means that the priority, once again, in terms of repayment, is not the highest. So subordinated debt is going to be repaid if after, let's say, after the repayment of other more senior debt. Okay. So what about refinancing now from the central bank? Okay, so this was the another question. So the question of being refinanced from the central bank is that, well, every day, as I told you, as you know, quite soon, so as you are well aware of, every day the balance sheet of every bank must be balanced. So in our case, if you look at our case, so in that case, if you make the sum of the asset side, the sum of the asset side is higher than the sum of the liability side without taking into account refinancing. Okay, so if you don't take into account refinancing, by not taking into account refinancing, so if you don't take into account refinancing, you obtain something like 12,000. This is the asset side. Okay. Okay. And if you look at the liability side, you have there is only 11,100. So there is this amount which is missing. So banks have several possibilities to have balanced balance sheet. One possibility is to go to the interbanking system and to ask for debt, for interbanking debt. One other possibility is to ask for the same refinancing debt, but from the central bank. And this is what is taken into account in this example. So refinancing from the central bank directly. And the central bank provides, for instance, the European Central Bank provides refinancing to banks which are in the euro area in Europe. Okay. Is that clear so far? Do you understand everything? I will. Of course I will. I will. Okay. So actually we are here. So now we're gonna look at the first question. So the first question is to compute the Tier 1 ratio and the international solvency ratio before the financial crisis. Well, it's easy. So you remember there the weight is 0, while over there the weight is equal to 1. Okay, so in that case, of course, the risk-weighted asset of this bank is 1 times 8,000 plus 1 times 2,000 plus 1 times 1,000 plus 0 times, sorry, no, it's okay, plus 0 times 1,000 plus 0 times 200. And this gives you 11,000, which is going to be the denominator in both the Tier 1 ratio and the international solvency ratio. Okay, so if you want to compute the Tier 1 ratio, so sorry, this is in French. So this is risk-weighted asset, right? It is Tier 1, which is given in the directly in the balance sheet. So 825 divided by 11,000. And it gives you 7.5, which is larger than the objective, the goal, okay? Now, if you compute the Cook ratio or the McDonough ratio, so the international solvency ratio, it's not only Tier 1 that you have to take into account, but all what is considered as capital, that is Tier 1 plus Tier 2 over, sorry, risk-weighted asset. So it gives you Tier 1 plus Tier 2, not an S, and it gives you 10%, which is bigger than the usual 8%, which is most of the time the ratio. Okay, so I think and I believe this is quite easy. Okay. No. About you don't have to learn by heart. For each asset class of. Sorry, to learn. You don't have to learn. Learn. No, it depends. No, it depends. Not necessarily. It's not always directly written in the liability side of the balance sheet. It depends. Here it is a very simple exercise, so I give you directly Tier 1 and Tier 2. But probably you will have to, yes. Because sometimes the regulator can ask a firm to, not a firm, sorry, a bank to give the value of Tier 1 and Tier 2. But in the balance sheet, most of the time, not really. You have all the ingredients, of course. You've got all the ingredients to compute Tier 1 and Tier 2 capitals. But most of the time, you have to remember how to compute Tier 1 and tier 2, and then take the ingredients and to compute yourself tier 1 and tier 2. Okay. So what about the rest of the exercise? So now there is the financial crisis. So due to the financial crisis banks are facing during the quarter, an unintentional increase in outstanding loans up to 600, broken down into 400 credits on LBOs being set up at the moment of the crisis occurred, and that the banks failed to unionize and therefore to yield to investors, and in 200 short-term lines of credit to supplement investors' refusal to fund bank securitization vehicles. So an increase of 200 credits corresponding to the trend development of banks in this phase of economic cycle, an increase in the number of private shares held by 200 as the result of the reintegration into the balance sheet of securitizations vehicles, a transaction in which the bank operates in order to preserve their reputation, a strong increase in deposits up to 300, investors favoring risk-free investment, a discount of 5% to be recorded as a loss of net banking income, on the 400 LBO credits pending syndication due to a deterioration in market conditions, and a 10% discount on outstanding RMBS to take account the predictable depth of the subprime crisis. These two haircuts are taken into account at the level of the net banking income and thus impact the operating result. A net operating profit trend equal to 100. So therefore, when we talk about a net operating profit trend, this means after normal cost of risk, but excluding impairment of assets related to the financial crisis, impacting operating profit, and before corporate tax. So a lot of things. And of course, all of these are going to impact the balance sheet. So now we will have to find the new balance sheet. So we will have to compute a new balance sheet, taking into account all of these aspects. And this is basically what is written over there. Okay, so we're gonna look at each line. So previously, we had 8,000 as credit to Haswell Incorporated. So we take the 8,000 plus 200 plus 6,600. So this is coming from unintentional increase in outstanding loans. And somewhere there is this notion of depreciation. Where is it written? Yes, over there. Over there. So you've got 5% times 400, and this is going to give you 20. So this gives you this amount, which is now reported over there, first one, first line. What about corporate bonds? So this is coming from the 200 short-term lines of credit. No, this is already, sorry, we already took that into account. So this is coming from 200 credits. Okay, so in that case, it is 2000 plus 200. So here you've got 2000 plus 200. So what about RMBS? So if you look at RMBS, there is an increase by okay, so there is a discount over there, 10% discount. So 10% discount, you've got actually 1000 minus 0.1 times 1000. This gives you this amount. And nothing is related to, so there is no change whatsoever associated with assets issued by states. Moreover, there is an increase over there of deposits. So because here there is an increase by 300 of deposits, so it is plus 300, and this also implies a modification in the bank reserves in the central bank, because this is 2% times this amount, right? So it gives you 206. Okay, so the asset side, it's okay, but look at the liability side, and there is something which is modified. Of course, the refinancing level from the central bank is going to be modified, but not only. capital 1 is modified. Look at capital 1. You see that it is no longer 825. Why is it the case? So Tier 1 was affected. Why is it the case? Do we have an idea? Why is it the case? Who knows? Because what? Because capital in market value is a buffer for risk. In other words, if there is positive profit, market value of equity is going to increase, but if there is a negative shock, market value of equity going to decrease. And this is basically what is the case here, and this is what we are going to compute. Okay, so the market value of capital absorb shocks, either positive or negative, and this is why capital is a buffer against shocks, and in particular negative shocks, of course. The higher the level of capital, the lower the probability to go to bankruptcy, because the market value of capital is going to absorb these shocks, so it is going to fluctuate, even to decrease. But once again, if you don't pay dividends to equity holders, a firm is not going to bankruptcy. But if you don't repay interest, if you don't serve your debt, then the firm goes to bankruptcy. That's a strong difference between the two possibilities in terms of financing a business. Okay. This is what I'm going to do now. Okay. So computing right number is what I'm going to do now. Just now. Okay. Okay. It's a good question, by the way, but this is what I'm going to do now. Okay. Okay. So result. So it is 100 minus so it is minus 20. And this is why over there you've got minus 20. And this gives you 805. So this gives you the result, which is over there. And once again, capital, tier 1 capital, true capital, is going to absorb shocks. Okay, so now we've got the new balance sheet. So this is a balance sheet after the financial crisis. And you see that if you look at slides, remember yes, here. Do you see the slides, by the way? Yes. You hear me now? Is there a problem? Could you hear me correctly, please? Okay, I will repeat. Okay, I will repeat, no problem. But you remember, I'm quite sure that you remember that one problem during the subprime mortgage financial crisis was a lack of capital. And this is something that we are going to see in this exercise, very simple exercise. So let me now come back to this very simple exercise. So you hear me correctly? You hear me? You hear me correctly? Okay. So, okay, so let me repeat this. So actually, if you look at this, it is written that these two haircuts are taken into account at the level of the net banking income and thus impact the operating result. So the operating result now is the usual operating result, 100 minus these two losses. So it is 100 minus 100 minus 20. So it gives you minus 20. And this is going to impact the market value of capital. So the new value of tier 1 capital is the previous value minus this loss. And it gives you 805. Okay? Is that clear so far? Is it clear? Is it clear for you? Okay, great. Thank you. So if you look at the new balance sheet, you see that there is a strong increase in the asset side compared to the liability side. Okay, so huge increase compared to the liability side. Of course, there is an increase in the deposits, but this increase is much lower than many increases in the asset side. And moreover, due to bad results, let's say, there is a decrease in tier 1 capital. So of course, there is a need for refinancing. So if you compare the two balance sheet, you see that So this is the difference here. So this difference is higher, much higher than the difference in terms of than which is stronger than what we had before. So before the value was so let me think of this. Yes, of course. So this is going to increase. So this is going to decrease, and the increase is higher than plus 30. So there is a need for more. So okay, let me say it again. Sorry. So there is first the asset side increases. Tier 1 decreases. And also deposits increases. But if you make the sum between so if you make the increase in the asset side, this is higher than the increase in deposits minus the decrease in tier 1. Okay, because it's not ceteris paribus in the liability side. It's not ceteris paribus. So there is an increase but a decrease. So you have to take the two effects into account. And therefore, there is a need for refinancing. Okay? Okay, so is that clear so far? Because I think it's time to make our usual break. Because I want you to stay alive, huh? So I think it's time to have a dinner for you. It's dinner time, I think. Okay, great. So see you in 25 minutes. Okay? Enjoy your dinner. See you later. No, not only on RMBS. Not only. It's not only RMBS. It is. No. It is all the discount actually. And in our case, we have two discounts. One RMBS, but also 5% in credits. So all the discounts. Okay, not only RMBS. Even if RMBS is the discount which is the highest. Okay, but discount in RMBS is the highest. See you in 25 minutes. Okay. So I think it's time to finish the break and to start again the lecture. So let's do that and let us finish this exercise, right? Okay. So we talked already about lack of capital. At least, no, sorry. The need for refinancing, But now we are going to talk about the lack of capital. Well, it's easy to understand because on the one hand, the asset side increased and the capital side, like for instance, tier one, decreased. So inevitably, there is a lack of capital in order, for instance, to satisfy international solvency ratios like the Cook or the Magdenuth ratio, right? So compute the other question is to compute the new value of tier one ratio. Well, we know already the numerator. The numerator, it is 805. And what about now the new value for the risk-weighted asset, right? Well, it is basically the sum of the three lines. Okay, because for these three lines, the weight beta is equal to 1, and for the other two, beta equals 0. So if you make the sum, you obtain this amount. Okay, this plus this plus this, and you see that this is lower than the targeted value. Okay, but what we can do also, and I let you compute because you can tell me, is to compute whether the international solvability ratio is still satisfied. So it would be so this is yes, it's still percent. So this is higher than 8%. But in any case, this is lower than what was targeted by the bank. And therefore, in order for the bank to verify, to respect its objective, it has to look for capital, new capital. Okay, so this is why over there it is written that the target of a Tier 1 ratio above 7.2% is not satisfied. So, of course, if you want to increase so as to increase Tier 1, Tier 1, there are two possibilities. Well, three. So increase numerator, decrease denominator, or doing both at the same time. And at the same time. Okay. But, well, trying to modify the denominator was a little bit harsh because no one in the marketplace was really willing to buy this kind of asset. So the other possibility was to increase numerator, that is, this is looking for new capital. Okay. So to restore the level of Tier 1 ratio corresponding to the desired rating, the bank will either increase the numerator or decrease the denominator, or both at the same time. The increase in capital in equity requires the reduction of dividends, well, if possible, and a capital increase. This is what many banks have done because of the subprime crisis, like Citigroup, Merrill Lynch, UBS, l'Union des banques suisses. UBS means Union des banques suisses. It is in French. Morgan Stanley, often using Asian or Middle Eastern sovereign funds. These funds having the means of mobilizing very large funds in a record time. The reduction in the denominator requires either the transfer of loans or private securities, particularly through securitization or syndication, which is difficult in times of crisis. Banks may be forced to ration credit to limit their outstanding amount, but limiting credit is not good news for the economy, because if you limit credit, you're going to limit the GDP increase, and moreover, this is not a good news in a period of recession. So this is kind of a vicious cycle. The central bank surveys of commercial banks highlight tighter credit conditions for all types of credit. It should be noted that vicious cycles can be set up, just what I told you. The weaker growth is, and the more the US housing market deteriorates, the more the constraints on the bank intensify via provisions and depreciations of assets, which leads to a more pronounced tightening of credit conditions that is pushing down economic growth and the real estate market. Ultimately, the financial crisis results in recapitalizations of some banks, but also by more expensive and in some cases more rare credit. The impact on household demand, purchases of housing and durable goods, and businesses is therefore negative. In the extreme, this depressive impact can be very important, which justified the sharp decline in key rates in the United States, for example. There you've got depreciation due to subprime crisis in billions of dollars. And so remember that these depreciations actually, of course, reduced in some extent the amount of RMBS. So because on the one hand, you can think that, well, if there are depreciations, the asset side is going to decrease, and therefore, why is there any question of capital, of lack of capital? Okay, so the first reflex is to say that if there are depreciation, why do we face a lack of capital? That's the question. Well, for two reasons. First reason, because there are depreciation, but also other increases in the asset side. So this is something we already talked about in the previous questions. Like many things which were that the banks were obliged to put in their ability in their asset side. And the second reason is that depreciation impact negatively the operating result, which also impact negatively tier one, the level, the market value of tier one. That is the market value of capital already included in the liability side of the balance sheet. Okay. And there you've got examples. And you see that, so not for a long period of time, let's say no more than 6 months. And you see that, so remember, it is in billions of dollars. So huge depreciations, huge losses of money, amazingly huge losses of money. Over there, for instance, you've got Lehman Brothers. And the world champion was UBS, Union des Banques Suisses. UBS. Okay. So this is for this exercise. Okay, so basically, do you hear me correctly? No problem with that? It's important to know. Okay, great. So, do you have questions about this exercise on the prime crisis? No? So if there is no question about this exercise, maybe we can look at another exercise. Tomorrow tomorrow I'm going to talk about risk management for banks, trying to understand why it failed during the once again the subprime mortgage crisis. But today we can do extra exercise. Yes, leverage buyout. Okay, so LBO is leverage buyout. So this is one way to buy a firm. So most of the time is quite aggressive. But in order to do that, the guy who is buying a firm is using a lot of debt. So this is why we're talking about leverage buyout. Oh, I see. I see. So good question. It is related, well, it is, the answer is very simple. It is related to a bank balance sheet for a very simple reason. So let's say in normal time, in regular time, the bank would just have played the role of financial intermediary. But during this huge crisis, bank was actually unable to find gather together to pull together um, uh, let's say small investors, and it was obliged to lend directly to to the guy interested in doing the LBO. So in other words, in normal time, the bank is not financing directly the LBO, but during this huge crisis period, banks have financed directly LBOs, and therefore LBO's credits, let's say, were included in the bank balance sheet. Okay, so in period time, it's not financed with the money of the bank. So the bank is just making things in order to simplify the life of the guy who is willing to make the LBO. And by doing that, of course, the bank obtains earnings. But during the crisis period, it was impossible to find people ready to invest. So the bank was forced to do that itself. That's the way. Okay, this is how you can understand why this amount was included in the asset balance sheet of the bank, right? Could be simply as loan to corporate. Probably. Okay, so let me go through. So that one we talked already about. Okay. So we are going to look at this exercise. What about the... I'm not quite sure to understand perfectly the last two questions. Okay. Coming back to the last exercise. The last exercise was about excessive risk taking. Okay, great. Okay. So what I'm going to talk about now is the case in which there is both moral hazard and adverse selection together. Okay, so moral hazard and adverse selection together. So we already talked about a financial market with moral hazard. We also talked about a financial market with adverse selection. But what we want to look at now is the case of a financial market with both moral hazard and adverse selection. Okay, so basically, and it's going to be the case for during all this course. The model we are going to consider is more or less always the same. So by the way, it is Armstrong and Tirol. Model. And if you look at the book by Jean Tirole, Theory of Corporate Finance, you've got this model from the beginning to the end of the book. So let's say a borrower has cash endowment capital A. So capital A is retained earnings. Okay, so that is the amount of cash that an entrepreneur, let's say, is able to invest in the project. But that guy, in order to realize a project, must invest more than A, capital A. So that guy needs to borrow money from outside investors. So the investment yields are in case of success and zero in case of failure. Borrower is protected by limited liability. So these are things that we know quite well. I mean, this is the kind of binomial model. The return is either R or zero. And in case it is a failure, the entrepreneur cannot pay anything to lenders because thanks to the limited liability which protect him or her. Okay. So the probability of success of the investment depends on the behavior of the entrepreneur. So it's very as usual, let's say. So there is a problem of moral hazard in the sense that the probability of success is going to depend on his or her behavior. So here we're talking about working versus shirking. So working, so it is the way that Armstrong and Tyrrell talk about that. So working is behaving well, while shirking is behaving badly. Okay. Of course, if there is a good behavior, probability is pH. So this is in case of good behavior, while in the other case, got PL. So this is in the case of a bad behavior. And moreover, we have pH, which is greater than PL. So the behavior is not observable. So there is moral hazard. Okay, so the entrepreneur behavior is not observable outside the firm. Outside the firm. And if there is, and in case of a bad behavior, there is a private benefit for the entrepreneur. So all of this, I mean, non-observable behavior and private benefits in case of bad behavior implies that we are talking about a moral hazard problem. Okay, so we have, in that case, a moral hazard problem. Okay, is that clear for everybody? Do you remember that? Is that clear? Okay. Okay. Cool. But in this exercise, there is something else, which is that there is also a problem of adverse selection. So let me now talk about the other problem, I mean the problem of adverse selection. So why are we talking about an adverse selection problem? Well, actually, so there is no private benefit when working. However, the borrower, the entrepreneur, enjoys a private benefit when shirking. But what is different from before is that the value of the private benefit depends on the kind of entrepreneur. There are two kinds of entrepreneur. So there are, let's say, big private benefit entrepreneurs. So for them, the level of private benefit is capital B. And you've got small private benefit entrepreneurs. So for them, the level of benefit is small b. And of course, capital B is greater than small b. Okay, so this is greater. So for any, let's say, for any entrepreneur, behaving badly yields a private benefit. But the value of this private benefit depends on the type of the entrepreneur. There are two types of entrepreneurs, one for which the private benefit is bigger than for the other. Okay? And why are we talking about an adverse selection problem? Because actually, if you are an outside investor, you don't know when someone is asking for, when an entrepreneur is asking for a loan, you don't know whether you are facing a big private benefit entrepreneur or a small private benefit entrepreneur. So this is a characteristic which is not observable per se. So this is why we're talking about an adverse selection problem. Okay. The only thing that you know is the non-conditional distribution, the ex-ante distribution, and you know that big private benefit entrepreneurs, so the proportion of big private benefit entrepreneurs is 1 minus alpha, and the proportion of small private benefit entrepreneurs is alpha. So everybody, I mean, no, not well, I mean, lenders know the ex-ante distribution between big private benefit entrepreneur and small private benefit entrepreneurs. But they don't observe the entrepreneur behavior. So there is moral hazard, and they don't observe directly type of the entrepreneur. In that case, there is an adverse selection problem. Okay, so we are mixing actually the two very usual problems all together. Okay. So everybody is risk neutral, does not discount the future, and is protected by limited liability. Moreover, lenders are competitive, which implies that they are going to agree. They agree to grant. They agree to grant financing whenever their expected profit is just positive. Okay. So is that clear for everybody? Is that clear? Is that clear for you so far? Okay, so if there is no question, I continue. Let me continue. Okay. 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 So as usual, if the entrepreneur shirks, the NPV is always negative. So why is it the case? Because even if you include the non-transferable private benefit, so actually this is bigger than the NPV. This is already negative. So necessarily the NPV is going to be negative. Okay. So here we have two inequalities. Moreover, there is another inequality which is written over there. And the question is to show that these two conditions imply that there is no landing actually in equilibrium. Okay, that is what we want to understand. Okay, so let me open something else. Okay, great. Okay, so consider a big private benefit entrepreneur. And we are going to write the incentive compatibility constraint of this kind of entrepreneur. So denoting R lenders. So the expected gain of an entrepreneur, if he or she chooses to work, is PH. So in our case, this is, I don't remember exact, sorry. This is, it is written R. So it is R minus R lenders. And this has to be higher than PL R minus R lenders plus B. So this is equivalent to something we are well aware of, that is to say R minus R lenders then okay, so this is for big private benefit entrepreneur. So what about now consider small private benefit entrepreneur? So for them, the incentive compatibility constraint is PHR minus R lenders, which should be greater than PL R minus R lenders plus small b. So it's more or less the same, except that R lenders should be now lower than R lenders max, which is now equals to R minus small b over pH minus PL. But of course, we have that R minus B over pH minus PL. This is greater than R minus B over pH minus PL. Okay. So another way to write exactly the same is to say that so this is repayment to lenders in case of success. So you see that, so for the entrepreneur, it is equivalent to receiving R minus B, well, capital B over pH minus PL, which is equal to B over pH minus PL, 0, or R minus B over pH minus PL, that is B over pH minus PL, all 0. So this is what is in blue corresponds to what an entrepreneur receives in case of success. Okay. So you see that a financing contract is what is called a sharing rule contract. A sharing rule contract. Why? Because actually it specifies the initial amount which is borrowed. So in our case, it is minus I minus capital A. And then, so there is R lenders and R minus R lenders, which is given to entrepreneurs, to the entrepreneurs. So in our case, there is something like 2 maximal contracts. That one. So this is, let's say, contract 1, and you've got contract 2, there is a mistake since it's small b. Small b. Okay. So you see that if contract 1 is offered, any type of entrepreneur is going to prefer behaving well. Okay, so the probability of success of project, a finance project, is going to be alpha. So alpha is the probability of being alpha. Alpha times probability of work knowing that it is small private benefit entrepreneur plus 1 minus alpha times probability of work knowing that it is a big private benefit entrepreneur. But with contract 1, both of them prefer to work. So it is alpha pH plus 1 minus alpha pH. It is pH. So the pledgeable income, we already talked about that, is pH times R minus G over pH minus PL. But this is lower than capital I minus capital A. So this implies, well, this inequality, this implies that the participation constraint of lenders, of the lenders, is not satisfied, and there is no financing. There is no financing with contract 1. Is that clear? No financing with contract 1. So the other possibility is to offer contract 2. Okay. So what about if contract 2 is offered? If contract 2 is offered, only small private benefit entrepreneurs prefer to work. Big private benefit entrepreneur prefer to shirk. Okay? So now the probability of success, it is no longer pH. It is alpha pH plus 1 minus alpha PL. Because there is an adverse selection problem. So a lender doesn't know who he's facing. That's the problem, actually. Okay. So in that case, the pledgeable income becomes alpha pH plus 1 minus alpha PL times R minus B over pH minus PL. And this is also lower than capital I minus capital A. So with contract 2, there is no lender ready to finance. Okay, so there is no financing. No financing. So if you look at the inequalities, there is another inequality. Another last inequality, which is pH R minus B over pH minus PL, which is greater than capital I minus capital A. So how could we find this inequality, and in particular, this pledgeable income? So this would be the pledgeable income of small private benefit entrepreneur without problem of adverse selection. In other words, without a problem of adverse selection, small private benefit entrepreneurs would obtain financing through the use of contract 2, but big private benefit entrepreneurs would not be financed. Be financed. So for them, there would be credit rationing. Okay. Oh, did I know that the pledgeable income is lower than capital I minus capital A? Good question. But the answer is really easy. I know that because it is written on the exercise. Let me show you again. This is precisely condition 1 . This is not always the case in reality, but it corresponds to part of condition 1 and condition 2. Okay, this corresponds to condition 1 and condition 2. Okay, is that clear for you? Is that clear now? Okay, great. Other questions? It's time. Let me know. Come on. Well, if you don't have any more question, let's say we're going to stop now until tomorrow for the last normal lecture, and then another question and answer Q&A session on the 26th of May. Is that okay for you? Yeah, but you've got already the slides. Which slides are you talking about? Exercises. Yes, I will. I will. Okay, I will. Oh, I see. PowerPoint. I will. Sure. Okay, see you tomorrow. Great. Good evening. See you tomorrow.
You are currently the only person in this conference.